an event held on Saturday morning. I'm grateful to you for, I presume this is the people who see no difference between work and leisure. So I'm Thye, the president of the Cheah Institute on Southeast Asia here at Sunway. Today's talk is part of Sunway's University presentations on frontiers of knowledge. Last month, less than a month ago, we held a workshop on precision medicine that was organized by Professor John Thorpe of Cambridge University, now Oxford University. That was a conference, a two-day workshop on molecular level-based medicine. In other words, the treatment you get is based right on the DNA of person's DNA. Well, today we switch to a different aspect of knowledge, the social sciences. Before I introduce to today's speaker, I'd like to tell you all about an exciting development at Sunway University. Tan Sri Jeffrey Cheah has just gifted US $10 million to the United Nations Sustainable Solutions Network to establish a Center for Global Education and Research on Sustainable Development. Sustainable development is more than environmental sustainability. We all know about climate change and now experiencing a record heat wave here in Kuala Lumpur. It also refers to the importance of economic sustainability, especially in light of the 2008 global financial crisis, and also to social sustainability, the importance of inequality and its unexpected consequences, as seen in the rise of Donald Trump and Bernie Sanders. And, of course, in political sustainability as well. We in Malaysia have heard a lot about rampant corruption outside of Malaysia and how that is undermining governance. And so sustainable development is about sustainability on all four fronts: economic sustainability, social sustainability, political sustainability, and ecological sustainability. So today's presentation will be on economic sustainability. Our speaker today, Professor Seppo Honkapohja, like many of us, received his sixth form education in English in Wales, but in search of a more rigorous education, he returned to Finland for his undergraduate and graduate training. With his education at such a finishing school, he soon became recognized as one of the world's most outstanding macroeconomists. So in 2004, he was invited to be professor of macroeconomics at University of Cambridge. His specialty has to do with learning, especially about macroeconomic phenomena related to the approach in economics known as rational expectations. And it was perhaps in rational expectation of the global financial crisis in 2008 that he returned to Finland in 2007 to join the monetary board at the Bank of Finland. So today we are very pleased to welcome one of the world's most outstanding macroeconomists, Professor Seppo Mikko Sakari Honkapohja. Welcome.
Thank you very much, Wing, for the kind introduction, and thanks for everybody for coming here on a Saturday. Nice-looking Saturday, though fairly warm one, it seems. I come from a northern climate, and this would be definitely very, very warm for me. here. I should tell since Wing mentioned this idea about the final crisis, when I had just accepted to move from Cambridge to the Bank of Finland, and then the following week the Northern Rock event happened in Great Britain, the first bank run in 140 years. A classic bank run where, except there was one modern part, which was the internet banking. Banking in Northern Rock collapsed right away because everybody wanted to take the money out. But even when I heard the news a couple of hours later, I went to see what's happening at the branch office itself. And yes, there was a line maybe of about 200 meters long, people wanting to get their money out. So it was a very classic bank run, a first one in 140 years in Britain. Anyway, so let me just tell you about the topic of today. So I'm going to look at the European economy, and with some emphasis on the euro area, and we will have a sort of a look at the overall development of the euro area with some emphasis on monetary policy, and not just because I'm from a central bank, but also because monetary policy has had to carry a big burden to combat the financial crisis. And even the aftermath now to try to get the recovery going, monetary policy in the United States, also in Europe, and has gone to the fairly extreme kind of measures to try to keep the economy going and into recovery. So that's why I think it's also correct to emphasize monetary policy in this. But let's start with the sort of the overview of the development. So here's a graph which shows you economic growth since 2005. So before the crisis, and then the crisis which happened in 2008 and 9, and then then what has happened after that. And there are several remarkable things, and we could go on for a long time. So the black curve gives you the world GDP growth in each year. And then the pillars give you the blue ones are the advanced economies, and then the light red ones are the emerging economies. And what you can see here, of course, you see the fast economic growth in the emerging economies overall, and that growth continued even in the crisis years. So whereas in 2009 we see that the advanced market economies were having negative growth there for 1 year. And so the emerging economies were becoming relatively more and more important in the global economy. But this thing has now developed, has started to change in the last couple of years, say from about 2012 or 13 onwards. If you look at the last years here, from 2013 in particular onwards, you see that first of all that there is some slowdown in global economic growth. The black curve is not having any positive slope. It's either horizontal or declining slope. In particular, last year, 2015, was somewhat weaker growth than before. So that's one development. The second one, if you look at the blue pillars, growth is accelerating in the advanced market economies, whereas if you look at the red pillars, they are smaller. So growth is decelerating in emerging economies. So that is a change which has now happened in, as I said, since 2013, and that we will see what happens in the coming years in the future. But that is a remarkable trend, I think. Of course, emerging economies are still growing faster on average than the advanced economies, but the difference is narrowing, and the fact that the emerging economies are growing in faster than the advanced economies is a widespread phenomenon. That's an understandable phenomenon because advanced economies are close to the frontier of technology and so forth, and it's more difficult to grow if you're on the frontier than if you're inside, further away from the frontier, and it's easier to find new innovations and technologies to take into. Just more or less, you can take it from the rest of the world to some extent at least. And so that's the development, and there are various reasons for this. In the first years we saw the financial crisis and the increased role, And then what we saw is most recently we have seen the oil markets. The fact that oil prices have collapsed, that has also been a part of it, because most of the advanced economies are importers of oil. I mean, there are some who are also, producers of oil and exporters of oil, but most of them are importers of oil. So in principle, the lower price of oil should help them, though there is now some discussion that this extreme decline in oil prices, is it really helping them, because the exporters are also being hit by the lower prices. So that is certainly one thing. And then possibly one other reason might be that monetary policy, which has taken a fairly extreme form, it's producing these results, but relatively slowly and not altogether. We are not claiming very major success, but we are claiming positive results for these what's called unconventional monetary policies. It has taken time, even in the U.S., to get the positive effects from unconventional policies, but that has I think we are starting to see them more and more. So here's actually. Let's look at these regions a little bit more in terms of time paths. So this is the level of GDP in terms of index numbers, and this looks at the advanced economies. So the red curve is the United States, blue curve is the euro area, and gray curve is Japan. You can see again the Great Recession there in 2009, and then all of these regions started to recover from the Great Recession. And broadly, qualitatively term, in similar developments after that in 2010. But then as we got towards the end of 2010 and 2011, the US continued on a recovery path. So that's a pretty steadily increasing path of GDP for the United States, whereas Europe and euro area, represented by the euro area here, actually overall went into a slight further recession, so something over double-dip recession. And that continued for 2011 and 2012, and only after 2013 has the euro area been into recovery and systematic growth. It's slower than in the United States, but nevertheless it's a positive growth, about 1.5% a year, roughly speaking. Japan is a more mixed sort of developments. They had in 2011, they actually had a decline in GDP. Remember, that was the big earthquake in particular. And then they had some recovery, and then sort of variable developments overall, and some positive growth, but relatively slow again. It's interesting to look a little bit further, the comparison between the United States and the euro area in terms of what are the sort of sources of growth, where do we come from? Economists traditionally have this, say that contributions to economic growth come from the capital stock, labor employment, and something what's called the total factor productivity, which is all the rest of it. The idea, that's the technological development and so forth. And so here's a breakdown of US growth, that's on your left, and euro area growth in terms of these factors. Let's not look at that Great Recession, because that's an exceptional. But if you look at the US, you can see that, all of these factors contributed positively before the crisis, and that has reappeared after the crisis. There's maybe some differences there between pre and after crisis, in the sense that the contribution from the capital stock is a little bit lower, relatively speaking, and whereas otherwise it's sort of similar. You see the total factor productivity effects there as well. If you look at the euro area, that of course there we know that the post-crisis, it was mixed, but you can see what is true there is that the capital contribution from the capital stock is very low after the Great Recession, and continues to be very low, whereas in the US it's kind of low, but at least it's there, and it's slightly increasing right now. And then employment growth has been, except for the crisis, a couple of crisis years around there, has been positive in the US, whereas it has had a very mixed development in the euro area. And only the past couple of years we are starting to see positive contribution from employment growth here for the euro area. So certainly again, U.S. development kind of more standard according to the textbook model, whereas euro area is having difficulties there, but maybe getting out of the difficulties. So that's sort of an overview of these things, and let's start to look at these things a little bit more, and here's first of all look at GDP growth and forecast for the next few years up to 2018 of world economy. And so I'm going to, in particular, since I'm talking about Europe, I'm going to focus on what's called EU22, which is Euro area plus United Kingdom, Sweden, and Denmark, the most important countries which are not members of the Eurozone. And you can see that, yes, the growth rate is about 1.5%, and it's forecasted to accelerate a little bit, possibly, maybe to 1.7 in 2017 and 18. United States, over 2%, somewhere between 2 and 2.5%. And then Japan having lower growth systematically. Let me not get into the Russia and China too much. The inflation data is perhaps even more interesting here. If you look at the EU22 on top, which is that yes, we have this feature that the euro area and European Union has very low inflation at the moment. It was 0 in 2015. For this year, the forecast is 0.2. And by the way, that number in the parentheses is the previous forecast from last September. And then it was forecasted to get back to 1.1. So a major revision in the inflation forecast in 6 months. It's downwards. And then the forecast is for gradual increase in inflation, but even 2018 only back to about 1.6 in Europe, which is below, for example, the euro area target of effectively 2%. And so yes, this issue of inflation is a tricky one, and this year we are going to be hovering around 0, and we were 0 last year. So there is a risk of getting into more systematic deflation if inflation does not start to pick up. And obviously, if you start to get to 0 inflation or even small deflation more systematically, that's symptomatic of what Japan has been experiencing. They've been in that situation for nearly 20 years now. So that's an important development. That's perhaps more surprising. And so if I look at things from the European point of view, and look at briefly about the risks for the forecast, we see it as that it is. It's this global slowing down of global economic growth is definitely one possible risk, which is mostly external to the euro area, and in particular that might have come from China. It might come from oil price developments further, and various other things are possible here. So there are some external risks, but these are on the global economy. Internally, we also have some risks that we foresee that might happen in the next couple of years. One is that the recovery is weak, as I've been saying, only 1.5% growth, and there are still these debt levels are very high. The public debt ratios the GDP ratios are pretty high in many European countries, and this of course is true for the rest of the world as well, and they are actually not particularly high compared to the rest of the world, but nevertheless they are on the high side. And there are also some countries where private debts are high, continue to be, so that's what's termed here the long-term effects from the financial crisis. That can happen, and of course we have now some political uncertainties on that are taking a toll in the sense that people, they are discussed a lot, and everybody is realizing they are an uncertainty. They will be resolved, at least one of them, in June. But this is an issue. How much? And businesses are certainly saying that this is postponed. They are postponing their plans. They are making new plans. In particular, the Brexit, i.e., the referendum on Britain leaving the European Union, that's going to take place on June 23rd this year, is a major source of uncertainty. The British economy is one of the largest in the European Union, and that their departure would certainly spark a great deal uncertainty and difficulties and turbulence into the system. I might come back to this towards the end of the talk if I have time. The interesting question is, from a purely economic point of view, how does it, for example, how does trade of Britain with the EU and the rest, and compare it to the rest of the world, trade with the rest of the world, how does it look like, and so forth? And you see that there are close ties, and therefore, if the Brexit happens, then obviously that's going to spell difficulties for Britain. And there are then a lot of arguments about, is it easy to find new trade agreements and so forth. The other one, which is a major difficulty for EU, is the refugee crisis which erupted last year. That, I mean, there was a start of it in 2014, but 2005 was very difficult because you started to get hundreds of thousands of refugees coming to the European Union, in particular Germany, but many other countries also, even including Sweden and Finland, which are very far in the north. So altogether about 1 million refugees, I think, roughly came in 1 year, which is one of the biggest movements. I think it's the second biggest movement of people around Europe in 1 year after World War II. Right after World War II, there were even bigger movements of people. But so it is a non-trivial, and the question is, will it continue this year? The war in Syria continues, and the Arab world is in turmoil, and so more broadly in turmoil. So it could continue, but on the other hand, there are now some measures in place, which were not in place last year, and so it could calm down at least to some extent. So those are certainly risks to the Euro area and more broadly to the European Union. But let's get back to the economics for the time being. Maybe we can talk about these risks, especially the political risks, a little bit late, towards the end of the talk, if there's time. So here's the growth, and the one important feature is that the development in the euro area is quite uneven. So here what has been done is to split the euro area countries into two groups, something called the high-rated economies. This refers, of course, to credit ratings agencies' ratings. So high-rated countries are Austria, Belgium, Finland, France, Germany, and the Netherlands. And then what we call the GIIPS countries, or you could call them the former crisis countries, which are Greece, Ireland, Italy, Portugal, and Spain. And you can see that what happened, in fact, in the past, since the Great Recession, is that these are very different developments. The high-rated economies, which are shown in this red curve, there in 2011, growth didn't turn into a recession. It sort of stalled and became very slow, but slightly positive on the whole. And it has been that way, and then it got a little bit faster. But then if you look at these crisis countries, the blue curve, they hardly recovered from the Great Recession. There was just a little bit of recovery, and then this second dip of the double, second part of the double dip recession was quite a heavy one. You can see that that's an index number. So from about sort of 105, you went down to about 96, 97. So almost 10%. So that's a huge decline, second decline that they experienced. So let's look at them a little bit more closely. So here are the GDP developments of all of these countries, individual countries, and you can see that there is no typical pattern. There are two sort of things that first stand out. One is Ireland. That's the greenish curve there. Ireland, of course, had a difficult period during the Great Recession. They basically had a massive banking crisis. They had a real estate boom, and then it resulted in a massive banking crisis. It's too early to tell. There are ways of measuring the fiscal costs of banking crises. This might be the biggest one ever for the advanced economies relative to GDP. We will see. I mean, the numbers are not fully very reliably around yet, because doing this comparison is kind of hard, because you have to determine which year's GDP you have to look at, and then you have to get the gross versus the net. And the net you can only get years afterwards, because what happens in this, when a banking crisis erupts, some of these assets end up in a government agency, which then gradually sells them. So the government eventually earns some of the money spending back. from this, and this process is still in its relatively early stages in this, and often these agencies take their time because the property values you want them to recover as well. So that's one part of it. The second one, there's some message. The other extreme case is Greece there, which is that blue curve, which you can see that they didn't recover at all from the Great Recession. There was effectively no recovery, and then there was a more rapid decline since 2010. That's when the sovereign debt crisis, in particular the Greek case, started, and that recovery is quite big. As you can see, the index number for GDP was about 105 in 2010, and it went down to 80, 25% of GDP, and pretty permanently, in the sense that even if the euro area overall has been on recovery since 2013, Greek economy is not. It's just leveled off, and it stays there at that low level. The other ones are kind of somewhere in between. They had a weak recovery at best from the Great Recession, and then this second part of the recession, and then some recovery. And the one in yellow, Spain, it's a fairly it's starting to look good, in the sense that there's a very good recovery going on, and they are into sort of 3% growth, or slightly more than 3% growth right now. They also had a banking crisis, a real estate and bank boom and a banking crisis, and they've gotten over it, and they are growing fairly well now. Then in between, Portugal is still there are some question marks, especially political ones right now, and then Italy has had a growth problem for a long time, since at least 15 years, maybe 20 years, but they are also slightly into positive growth, as you can see from the dark blue curve. So that's the picture, and I'll let's look at these developments, various aspects of it, as we get there. Yeah, exactly. Here you see how you dependent you are on modern technologies. I remember, many years I attended the talk. This was almost 10 years ago, a conference talk about then it was called the new economy, and there was a specialist on the new economy, and he was going to give a talk based on this. Then it was very exceptional to have this kind of technology. It didn't work, and he said, luckily I brought the old technology, and then transparencies, old-fashioned transparencies as well. So these new technologies are sometimes problematic. Anyway, here's the unemployment picture, for the euro area. So this crisis time has led to big increase in unemployment. The dashed curve is the overall. That overall went from a little bit above 7 to 11 and almost 12%. It's now declining. So from 12% unemployment rate, we are down to about 10.5 now. 10.5 now, and looks like it's going to continue that decline. Of course, things were much worse for the crisis countries. That's the red curve, which started at similar levels and went up to sort of over 18% overall. And they've now come down to about sort of 15.5. And there are some country differences there as well. Of course, the situation is the worst because they have no growth. Spain, Spain, which traditionally has fairly high unemployment, it's still high, but it has started. The decline is bigger. It's about 6-7%. So that's a good thing for Spain. Here's inflation. Maybe the differences are not that important. The important one is this: what we've already seen, that we've been at around 0 for 2015, and looks like we're going to continue to be there. So let's move to the debts. So this is first of all, again, the European or euro area debts with the split between high-rated countries and the crisis countries. And you see that these crisis countries in particular, with the Great Recession first and then the problems afterwards, led to very big increase in debt. The average was about sort of 75 there before the Great Recession, and we are now somewhere above 120. overall. And I'll show you the country breakdown. There was also increase in the high-rated countries, but it was much smaller, and the levels are not. Average level is perfectly tolerable. It's something like 75%, right? So here's in particular the crisis countries again. So you see big differences between the countries. There are also some interesting development. One important case here is Ireland again, which is that greenish curve. Ireland, before the financial crisis erupted, Ireland had very low debt, so a little over, 25% of GDP only. And then in a matter of about 5 years, it shot up to 120. And most of it is the banking crisis. A very big part of it is the banking crisis. And now it's on the decline. So they are sort of a little bit above 90. Spain is another example with low debt ratio before the crisis, and now they are at 100%. Again, one which had a big, not as big as relative to the size of the economy as Ireland, but they had a big banking crisis as well. And then Portugal overall, Portugal is more general. They had banking problems, but they've had other growth problems as well. So they're an increase as well. Italy, even though Italy traditionally has had far high debts, above the ratio has been around 100% for a long time, with some fluctuations, and it got up to about 130 now, and now it's forecasted to start declining. And then Greece, again similarly, tends to have high, if you look at the history, tends to have high public debt to GDP ratio, and are at very high rates, above 180. They had one restructuring of Greek debt, as you can see there in 2011-12, with the dip in that. And there are talks now about the second one. And actually, I just read in today's Financial Times that they claimed that there was some kind of a breakthrough, that they are close to agreement on how the restructuring should be done. So it was agreed last summer. I'm sure you followed the news last summer. It was much in the news whether there would be even a Grexit, or departure of Greece from the Eurozone, which didn't happen, but it was very close. And then they agreed on a new IMF EU program, and it was kind of agreed, but not the details of it were not agreed, that there will be some kind of restructuring of the Greek debts, because these ratios of 180% are quite high. and that looks like it's going to happen. The deal is not certain, but what was in the news this morning said that it's likely to happen. I don't know the details of the deal. The previous deal was basically one which didn't cut the debt capital, but it extended the maturity and reduced the interest rates. And something similar is probably going to happen, because there's a fair amount of resistance from other European countries to really cut the debt capital, because that will then mean losses for creditors, which are the European countries in many instances, because there are also some bilateral arrangements which were done early in the financial crisis. But so that looks like that is going to be solved as well. I'm now relying on the news that I read this morning. So that would mean that one of the uncertainties of this coming summer, the possible Grexit again, which was in the media a little bit, and possibly that might just not be a news or an issue this summer. Here's overall looking at what has happened in the stock markets in various regions. The European one is in the middle, the yellow one. So what we've seen since the financial crisis is in many areas big booms in stock prices. China is a little different. That's the sort of red curve. A red curve there. But then they had this huge spike, huge boom right in 2015, 14-15. Euro area, it's the same broad developments. Fairly long. Once the Great Recession was over, fairly long increase in stock prices with some fluctuations, and then in 2015 they have been coming down much of the year. There has been some volatility early this year, but now it seems to be stabilizing again. And that this is a fairly general development internationally. Here are some currencies here. So what we see here is the let me just pick up a couple of aspects here. One interesting thing is the comparison of the euro versus the US dollar. So the yellow and the dark blue curves, which since 2010 were going, movements, this is a nominal effective exchange rate, very similar. And they were sort of more or less, very closely related, but then that relationship, vanished in the middle of 2014. The US dollar started to appreciate, the euro went down somewhat, and so there is divergence, and that's what we see. And I'll come back to that when I talk about monetary policy. So that's one aspect of it. Another one is what has happened is of course Japan. You can see that, and that's the greenish curve. You can see that since 2013, Japanese yen has depreciated quite a lot. There was a fairly rapid depreciation at first, and then more gradual one until sort of middle of last year. And after that, there has been a tendency for appreciation, and there was quite a rapid appreciation in the beginning of the year, despite the fact that they continue to have this unconventional monetary policy with a lot of asset purchases. The U.S., as I said, the U.S. and dollar and the euro split is a fairly remarkable, but it does reflect a different situation. The European recovery is much more recent. It's recent, and also the policy mix of the European Central Bank and the Federal Reserve in the United States is different. We are into these unconventional new measures, introducing new measures, whereas they've stopped introducing the new measures, and they've even had a interest rate increase. So they are trying to get back to normal very, very gradually, but they are in the beginning of that path, and Europe will be some years off from that kind of development. And it shows in the exchange rate very clearly. So here's now, let's look at the European monetary policy. And so let me just show you, first of all, overall the extra measures, what the two, not the interest rate, but these asset purchases or credit operations or refinancing operations, how they look like here. So if we start here from 2007, so just before the financial crisis, and then there was, the Euro system is built in such a way that, there is always these credit operations, and it's in terms of this credit that ECB manages the day-to-day management for the monetary policy. That's how it's done. There's less reliance on open market operations than in the US, for example. But then came the autumn of 2008, and you see a very sharp increase in that. And that was so when the financial crisis started. Remember, in 2008 there was the Lehman Brothers bankruptcy, and shortly after that there were some interest rate measures by monetary policy. And what happened in Europe was that normally how this liquidity to the banks is allocated is through auctions. So a certain sum is allocated, and bids are asked, and then it's allocated. But then in the autumn of 2008, this system was changed to something what's called fixed rate full allotment. So banks can get as much liquidity as they want at the fixed policy rate, provided they have acceptable collateral. So this, because there were concerns about the liquidity of the banking system, this obviously, helped them a great deal in terms of the liquidity. They knew that yes, if there's a problem and if the bank is in reasonable shape, so that it has posted acceptable collateral, they can get the liquidity. So that one problem, uncertainty from the banks was taken away, and that was actually a reasonably, successful. It's still in place. We haven't gone back to auctions here. Then we started to introduce these new measures. Sort of targeted refinancing operations. So these regular refinancing operations are very short term. The usual term is, basic term is 1 week. They can be a little bit even shorter one, but 1 week is the basic term in this. But then you can see that gray area there, and these are sort of longer term. So one response was that let's provide more liquidity, more of these operations, even up, more 12 months or more. And you can see that the first one was for 12 months, and then in 2012 we introduced we introduced even longer terms. There were three-year maturity was introduced in some operations, and now there's going to be, starting in June, a 4-year maturity. I'll come to that in a little bit later on. And then there have been asset purchases. There has not been, has not been used by the ECB very much. A little bit earlier on. So that's the red part of this in the graph. And in particular, 2010 was when we had to start buying when the Greek crisis got acute, and the ECB started buying Greek government bonds.
Securities means equities?
Yes, no, bonds, Greek government bonds. So we went in. This was in May 2010 when over 1 week when it was decided, okay, well, let's start buying these, and the ECB started to buy this and eased off the pressure on it. The interest rates were going very, very, very high on Greek government debt, and they couldn't get any financing though. So that one part of that was that let's get interest rates down by ECB buying these bonds, something called the Securities Markets Program. That continued for quite some time, and then in summer of 2012, we also started to buy Italian and Spanish debt. Again, so that's why you see that the red area vertically gets bigger in 2012, and then this kind of, we stopped buying the Greek debt at some stage, and also the Italian debt and Spanish debt. No new debt were bought. That's why it remains constant. Actually, goes down slightly, because these debts are held to maturity and they mature. And I remember, this is just a detail, but when 2010, there was a lot of discussion, that this is crazy and you're going to lose a lot of money on buying Greek debt. Well, actually, what happened was that these have been good investments because we bought them at market prices. So when the interest rates were effectively very high on Greek debt, the prices were low, and there was also and we haven't made there has not been defaults or any restructuring on, because that one restructuring of the extending maturity was not influencing the central bank's holdings of these debts. They were excluded. So in fact, the return on these bonds investments has been quite good. So this is what sometimes happens. And then in 2015, we introduced a new asset purchase program, actually parts of it even at the end of 2014. And that now you see that the most recent part, there's a very steady increase in this. So here's what was decided to have, something called the expanded asset purchase program. Which is that you buy 60 billion a month of all euro area government bonds except Greek bond, because it doesn't have a good rating enough. It has a very, very weak rating basically. So we don't buy Greek bonds, but all the other ones we do, and according to some, effectively to the size of the country, relative size of the country. And so what happens is that EC buys some of them, and then the member country central banks also buy their own government's debt. So there you see what's happening. There are also some purchases of government bonds, so that you can see there is a sort of a reddish area there. And then a very small, which is not really visible in the graph, of asset-backed securities. There are some now newly designed asset-backed securities, not the old, what I should call garbage, which turned out to be garbage in the heap of the financial crisis. So there has been, the central banks actually have been pushing that, the asset-backed security is not a bad idea, but it has to be done well. And so actually the ECB and the Bank of England have been, telling what kind of asset-backed securities could exist. Yeah, these are mortgage-backed, but they're very explicit and not this, and the rating has to be done really transparently on them, and not just saying that it's AAA, even though if there's just a little top tranche of AAA, as was the case in the earlier ones. So you have to be very transparent and honest about these ratings, and so these are being introduced, but they are still rare. I think the idea was that let's have these clear terms, and hopefully the market will pick up, but it hasn't picked up very much. And then in March this year, it was decided to go from 60 billion to 80 billion. 80 billion, And we will start in June to buy corporate debt, which is another extension here. And so that you see that the slope of that dashed straight line comes higher at March. And now, for now, the decision is to do these asset purchases at least until 2017, end of March. So that's the setting here, and it was basically due to this weak inflation output. So let me just skip these a little bit, and here's basically one of the big sources of the problem, which we've already seen. One more time, we see the inflation outlook, which is around 0, and also something what's in Europe called underlying inflation, which is something like the core inflation. There are slight differences, but it's basically the same sort of thing. And even the core inflation is at 1% or below 1%, somewhere hovering around there. So yes, the inflation problem is definitely there. And so that was this avoidance of deflation is clearly a reason, and the idea that let's try to get the inflation back to the 2% target, or close to 2% target, which is there as the red straight line. There are some interesting, if one looks at this inflation development, there are some interesting things about it. Here is one graph which shows inflation expectations. We measure, obviously you want to have an idea of what inflation is going to be in the future. So you have to measure inflation expectation, what the markets think about them. And there are basically two ways to do it. One of them is to go and ask do a survey expectation data, ask the public or ask the professional forecasters or whatever or similar, and that has been done. And that's one measure that is being used. The other one is to use financial assets. In particular, there are inflation swaps, and you can then infer from these swaps what the inflation rate is. And here are those measures for the euro area. So you see what you see. I've also put in the oil price here. So there are, depends on the horizon. So the top ones, the light blue, and the green curves are for longer horizons, 5 on 5 years it's called, and 10-year inflation forecasts, and they have come down significantly from the 2% level. If you look at sort of 2014, second half of 2014, since that they have come down, and they tend to be going down systematically even now, and that is of course telling that there is a concern here, and this is very much related to the oil price, the yellow curve, because that started to go rapidly down in 2014. And it's been going down, except right now it's somewhat increased, but that's just a few months, so we don't quite know. And clearly, the oil price somehow affected very strongly the inflation forecasts, more strongly than traditionally is the case, and that was something which was a bit of a surprise, I think, to many people. Here's the U.S. euro area comparison is very similar. These are the market expectations, a summary measure, again long-term expectations of future inflation, and they have come down since 2014 in the U.S. and similarly in the euro area. But the level is higher in the U.S. So they are if they have a target of 2%, which they don't quite explicitly say, but effectively it is that they are hovering around the target, but whereas the euro area clearly has a problem. So here's a little bit more systematically what the policy measures were taken. There were also some interest rate decisions, and there is one which is a controversial measure, which is to have a fairly significantly negative interest rate on something called the deposit rate, this is the rate of interest that banks get when they deposit surplus funds to the central bank overnight. Usually it's overnight deposits, and that's now minus 0.4%. It's actually something called the required reserves are not excluded from this, but the excess material they have to pay. And these sums that they have been deposited are nevertheless non-trivial. So the Euro ECB is sort of testing how much, we've gone negative. So far things seem to be okay, but clearly the question is, can you go much further? I think the most negative rate is in Switzerland now, minus 0.75. and Sweden is, I think, 0.7, if I remember correctly. So those are the lowest or largest negative rates that we see at the moment. So there was the asset purchase program, and I mentioned that it's corporate bonds as well. Now that's a new territory for the euro area as a whole. There are some member countries which have bought corporate bonds before, but that's for reserves management purposes, not for monetary policy purposes. One of them is actually Bank of Finland. So we've been buying some sort of corporate bonds in the international markets for quite many years already. So we have some experience. So actually, there'll be 6 central banks that will be doing the purchases for this corporate bonds program now for monetary policy purposes, and we are going to be one of them. So you can imagine that our staff is pretty busy now getting the system in place. And then there was also, this is another interesting one, the last bullet there, this refinancing operation, or providing cheap loans to banks against good collateral. So a new program will start in June, and there it's a 4-year maturity and a 0 interest rate through the 4 years. But even actually a negative interest rate on that loan, if they increase their lending to private businesses, non-financial businesses and households, for non-financial purposes. This will be checked afterwards, and if there's significant, if a bank has taken out this loan, this 0 interest rate loan, and extends new credit to business customers, they will get a -4% interest in the end. So they will get a bonus in the end for having done the lending. So that's what will be tried now, because the concern is indeed that corporate lending is still kind of low. I'll show you some figures in a moment. And we will see how this will be received in June. So this was decided in March, but it takes time again to set up the legal framework and so forth. But it's there, and there is how much interest there is going to be from the banks is too early to tell now. And then there has been these statements about something what's in monetary policy jargon is called forward guidance, statements about what the plans are for the central banks to do. So this asset purchase program is to the end of March 2017 or longer if inflation is not steadily going towards the 2%, going up towards the 2% target. And also there's a statement saying that the interest rates will remain at present or even lower level even beyond the horizon of the asset purchases. So it's going to be first, eventually when we get to the second stage where we start to normalize, is that you stop the asset purchases, and then sometime afterwards there'll be, you might consider interest rate increases. That's where the Fed is now. They stopped purchases a couple of years ago, and they had the first interest rate increase at the end of last year, and are now thinking about the second one, according to what we've heard. So let's look a little bit about the effects of these policies. So here you see what has happened with these various expansionary monetary policies in the euro area on long-term bond yields, sovereign bond yields. That's the red curve, and then there's Germany as a reference curve. Remember that we had these special refinancing operations already earlier, which were fairly big. And yes, there's a very steady decline of these bond yields from around 4% to levels below 1%, or about 1%. For 10-year bonds, that's quite low. 1% rate of yield is quite low. So that looks like that has been successful. Here's what has happened on lending rates for bank loans to households and companies, and they have also come down. You better start looking at since 2012, because that's when some of the big operations were started, and then there's 2014 is when the asset purchase program started. So we see very steady decline in this interest rate as well, about a 1 percentage point decline since spring of 2014 when the asset purchase program was started. So positive effects, not huge ones, but significant effects. Trying to get a 1 percentage point decrease in bank lending to corporations and households for example, if the interest rates were higher, by interest rate policy would require fairly strong measures. So people think that these are kind of small effects, but they're not. In normal regimes, if you wanted to do this idea that you want to get the sort of general bank lending rates down in the economy by 1 percentage point, it would require fairly strong monetary policy measures even in normal times. So I think these are effective. Here's what has happened to lending, how much lending there has been, and one feature what was happened in this crisis was that both in particular corporate lending, but even household lending went a little bit negative in this, and they are now back in positive territory. So the household lending is increasing at 1.5 percentage point a year, and the corporate lending about 1 percentage point a year. So so again, I would claim that is at least in part the monetary policy actions which have been pretty bold here. So let me then move on to sort of more scattered topics around here to finish my talk, which is that other things have been done in Europe. I don't know. I'll mention this because people you might know so much. One of the big issues has been this condition on European banks, and something what is called the banking union was started. It was decided in the midst of the crisis a few years ago, and there in relatively fast, once the idea was introduced, it was also finalized and approved in the EU institutions and European Parliament as well. And so the banking union sets up a common banking supervision and regulation scheme for Europe. Now it's for Euro area and some other member, who are not member countries but wanted to come in right away. The idea is that hopefully that this will happen, expand in the future once times get a little bit better. So there's a single supervisor, banking supervisor. Actually, there are the national ones as well, but the biggest banks are supervised by a new single agency which is associated with the ECB. Then there is something which is quite an interesting one, which is something called the single resolution mechanism. So if a bank gets into difficulties, fairly serious difficulties, it'll be referred to this something called the SRM, which will look at it, and the question is, well, how to do with it? Then there are some hard decisions. Will it continue business? Will it be restructured somehow, and how, or whether it will be even closed down? And that's going to be done by an agency, the SRM, and there are some new ideas about it. There is something what's called investor responsibility now, or bail-in, not bail-out, bail-in. So if they have to wind it up, the bank, the investors will have to pay. Of course, shareholders, yes, but even junior bondholders, a certain part of their holdings will be taken as part of this winding up situation. And so that's happening. The other feature here is that there's going to be a fund that will be used here, and that is collected from the industry as sort of so there's kind of insurance scheme set up. The industry pays, the banks pay fees, and this fund is accumulated to handle individual banks that get into major banks that get into difficulties, and that'll be handled by the SRM. So there is the deposit insurance scheme is not far along. There is a proposal by the Commission, but there's a lot of debate going on. We will see what happens on that. So the idea is and most importantly, is that there is a single rule book now for banking supervision in all of EU. This turned out to be one big problem in the financial crisis, that even though there had been some harmonization, there wasn't really. The bank, what happens in major crises like what we've experienced is that the supervisors tend to favor their own country banks a little bit. It's not drastic, but there's a little bit of that, and this was very visible in the stress tests. At some stage, we were doing stress tests of the banking systems in different countries. Similarly, in the U.S., and there were certainly problems in this regard. And the banking system has gotten into better shape in Europe. So let me skip some of the graph. But this is an input. Here's about capital. About how much capital do the banks hold, and that has been going up in recent years. So they are in better shape. as before. So let me not get into the details of it. And the interest rate differential between lending and deposits is gradually coming down here, very gradually, but it's coming down. One problem that remains in Europe, in particular Euro area, in some Euro area countries, is that there are some, and Italy is the worst example, is that there are a lot of non-performing loans in banks. There are big differences. Many countries there's not a problem, but Italy is the worst, and then some of the other former crisis countries also have some more percentages, but Italy is clearly the worst case. And of course, they are a problem for bank performance, and you have to get that resolved also. But let me just skip here. So let me then conclude, since I was asked to, and I thought it would be a good idea, just to tell you what sort of give you a vision, just a little broad vision of where is Euro area heading, where is EU going. Obviously, we have these various questions and particular problem, but I think that very much the idea in Europe is that these are continuing projects. They are not finished projects, but projects which have had success, some setbacks, but have been steadily going on, and the plan is to continue. And the financial crisis obviously was a major disruption to this process. It's not fully over yet, but the situation is much improved, as you've seen. And so the idea is to continue on this line. And interestingly, as this financial crisis has receded, there is now more discussion about the future of EU and the future of the Eurozone in Europe. So there was last summer, for example, something called the 5 Presidents Report. That's the President of the Parliament, the Commission, the ECB, whatever, the 2 more presidents anyway, and about the longer term plans for the EU. And let me not get into the intricacies of it, but it looks like there are 2 visions about where especially the Eurozone might be going here, and possibly new countries will join the Eurozone. It's still a bigger part of the EU, and let me call them one which that this Economic and Monetary Union (EMU) with centralized steering, or EMU with market discipline. These are the main options. I think they partly speak for themselves, but what it means, the centralized steering means that you've got to have strong controls of member countries to make sure that the economic policies are according to the rule book and give stability, and that requires obviously increased risk sharing and joint responsibilities of the stability of the member countries. So that's one line. This is something what's sometimes called the fiscal union, but more generally I think it could be other areas as well. The problem in this approach has been, so far in the discussion, is that it doesn't seem to get enough support. Obviously, these countries, especially if I focus on fiscal union in particular, the idea that somehow the public debts would be mutual responsibility of the public debts. Obviously, the countries with higher debts, the southern European countries, would like this very much, and then obviously the northern European countries, which have low debts, don't like it at all. And so it's not going, because the idea is that you have to find a consensus. It's not going forward very much. So that's one part. That's why this looks like this centralized steering idea is debated a lot, but it has some major hurdles. It might still come, but I think it'll require quite a many years before that's a possibility. We need to get somehow a very much better normal situation. The other possibility is what is sometimes called this idea of European Monetary Union with market discipline, which says that the idea is that individual countries have much more individual responsibility. They will have responsibility of their macroeconomic policies and their consequences, and the legitimacy. This one has much better democratic legitimacy because it's the national democratic processes that are there, which are in place already, but the problem, of course, is that you have to make sure that the overall outcome is satisfactory, and possibly have some European level institutions to mitigate cyclical developments, and so that's so what you could have joint responsibilities, not between countries but between particular things, particular aspects of economic policies and the particular aspects of the economy, and through these kinds of institutions. So that's an alternative to it. It's a more sophisticated one, but it's the sort of thing that United States has. You have states, they run balanced budget, they don't get into debt problems like the Southern European countries have gotten into systematically. And they used to. And it was, of course, if you look at the economic history, Wing obviously knows it better than, it took 50 years, the first 50 years of the United States from the start before they got more or less to the current system. And so, but it can be done. Switzerland is another example which is very similar, which is, a federation, but where the cantons have a lot of power and responsibility, and it works very well. We've hardly ever read news about some canton getting into overall financial trouble or fiscal trouble. I mean, there have been individual cases, but very rarely. So this can be made to work, but it is obviously a demanding. It puts a lot of responsibility on that country member or whatever it is, and it may not work if the behavior of all the members is not responsible enough. And then if you could have some schemes which are common on top of that, then that might be a direction where EU is heading in the future. So I better stop here. I'm happy to answer questions. Oh, the Brexit. Oh, yes, I did have a little bit. I did have a couple of slides here on Brexit. So anyway, the referendum is on June 23rd, and this is being very much monitored here. And first of all, we don't know obviously what happened, but the what happens right away is that it sets up a process in motion which says that you have to renegotiate the relationship between Britain and the EU within 2 years. But if that's not successful, there's going to be a stalemate. And so very much what is in the open would be that how would Britain organize its trade arrangements with other countries, with EU, but even other countries further around. And so that's the one which is the big question mark. But that makes it difficult to assess the situation, because obviously, in this kind of, if you want to do a rational decision on this, you want to take the two alternatives, assess the pros and cons of both of them. But if you don't know the future in one of the longer-term future in one of the alternatives, or very difficult to assess, then this kind of approach is also challenging. So certainly the financial services sector in the UK obviously benefits a lot from the EU membership. And then there have been various studies about this. There's been there's that I mentioned there in this study by a group of economists in the London School of Economics. They came up with fairly negative consequences for the UK. The Bank of England published a study a couple of months ago, which also said that it's a negative risk to UK growth. But the discussion is very heated. So here's a little bit about here's the EU share of UK trade, UK goods exports, services and goods and total exports to the European of UK exports, and how big a share does it have? It's still fairly high. If you look at the blue curve, which is the total, it's between 45 and 50%. So almost half of UK exports go to the European Union. Now, if that becomes, subject to big uncertainties, it is going to have a major impact, I think. And there is, of course, the question, would it be this 2-year negotiation, would it be a friendly negotiation or a tough negotiation? I would opt for the latter. That would be my guess. So here's also the interesting one is that UK actually has a trade deficit in goods, but the surplus in services. That's the city in particular. In this trade with the European Union. So that's the setting. Just in terms of trade, it is a big thing for the UK, and I don't think people necessarily realize that if half of your exports are subject to a big question mark, then obviously it's a big thing in this. A few words about the refugee crisis. So we saw in 2015, it was actually more than 1.3 million refugees came, of which 35% sought asylum in Germany. They came not just from Syria, but that was obviously the biggest, 29% from Syria, but also from Afghanistan and Iraq, significant numbers. And this, it started in the summer very much, not last year, and the highest levels were in the earlier autumn months, September and October. And then of course EU has, the sad thing about it was that the EU was not prepared at all, basically, and then they only started to think about it and tried to look at and they came up now with this arrangement with Turkey, which will stop the biggest flow via Turkey to the Greek islands, and that flow has more, it's still there, but it's much smaller than last year, but the early months is the comparison of last year. And so that's the situation. Also, if you look at the number of asylum seekers in various EU countries in the early months of this year, it is much lower than last year. So that is where we are. Of course, what can happen is that these refugees start to go round, and the other short distance is from Libya to Italy, or from Algeria and in particular Morocco to Spain. The boat trips are not that long, and that could be the new route. We don't know yet. Obviously, the Turkey one was by far the most convenient for them and the shortest, but it could start to go the other way, and it remains to be seen. But I think there's countries are now better prepared in this sense. Also receiving them in Finland also received, even though we are perhaps the most northern country with Sweden, or even slightly, about the same, and both the countries received large numbers of these refugees. And it took a big effort to create them, centers where you receive them, you have to register them, and then start, finding them some where they can living conditions, start to train them as well. There are two important parts of training. One is obviously, in the case of Finland or also Swedish, language. If Syrians don't know any Swedish typically, or Finnish, even less Finnish, so that is an important part. The other one, of course, is just generally what the life in that country is like. What are the social norms and rules and so forth, and all of these have to be taught. And countries are getting better at this, so they know what these kind of schemes have to be in place, and countries are better at these. And so and many of these people are, especially the Syrians, but also from other countries, are relatively well trained. I mean, it's a big mixture. There are some who have little training and little skills, but there's also a good percentage who have even academic degrees, university training in different areas, doctors, whatever. And so those could be beneficial to the receiving country in the longer term. The trouble, of course, is that the first years are going to be hard, because you have to get them to adjusted to the new country, and get them to learn enough of the language, and possibly, depending on the profession, some further training, so that they know how that profession is carried out and work done in the receiving country. But the countries are getting better in this. I've seen this very much in the Finnish case too, because we've had traditionally very little immigration, but they were remarkably effective in this. And there are a few studies, not of the most recent wave, but of what's the impact of this, or what about these immigrants, asylum seekers and refugees in the longer term. It turns out that in 5 to 10 years, the employment rate in Finland, for example, is a little lower than the native population, but not much. After 10 years, it's just a few percentage points. So many of them in the working age, and most of them are in the sort of 30 plus or minus, when they big part of them are like prime working age people, will find jobs, but it will take time. It will take several years in any case. But these long-term numbers from the earlier, obviously this is earlier data from those who came a long time ago, is relatively encouraging in the sense that they can integrate into the society. So that's that. But this is one where the situation is very uncertain. Are the numbers going to be as high as last year, over 1 million, or is it going to be lower this year because there are these new controls in place? We will see. I mean, this is a big challenge. Then I think one final thing is, I should maybe say, other sort of more political. I'm not a political scientist, but one which is certainly worrying everybody who's in decision making is, of course, the rise of populism. We don't see it just in Europe. We see it elsewhere, in the United States, but this is a big concern that somehow the traditional institutions, including the EU institutions, are at risk there. Even them, they are at risk. They are still minorities, but the percentages that they get in recent elections are pretty high, have been pretty high, and might go up, especially, for example, if the refugee crisis gets worse. If Brexit happens, it might have an influence on the populism in the European continent. Who knows? Hard to predict. So this is a big challenge for how do you deal with that? And I don't have a good answer to that. We have an interesting experiment in Finland because we have a big populist party. It's the third largest party in the country. They are in government now. They are, there are the three biggest parties form the coalition government, and they are in government now. And actually their popularity has been going down significantly in the regular polls that are taken. So I think I better stop here.
Thank you. So we are now open. Well, we are now open for discussions. So please feel free to ask Cheah.
I have two sets of questions.
Sure.
Very quickly. One is, frankly, I'm very worried about growth in Europe. If you look at the latest numbers, Germany is beginning to feel the constraints, the pressure to slow. France, you did mention today, I think it's getting hopeless. Italy, you mentioned something. These are the three largest countries in Europe. They lack demand, and it appears that what the ECB is doing to try to pump up demand is not working. In fact, the impact is declining. Two questions arising from that. One is resort to reforms. You have not mentioned about reforms. I think reforms has to be a significant part to revive growth and productivity in Europe. So if you could spend a little bit of time on how reform like labor and things like that. And secondly, infrastructure spending, which relates also somewhat to fiscal policy. Why is that not being pushed much harder? For political reasons, I don't know, but if you could spend 1 or 2 minutes on that. My second set of questions regards monetary reform. It's actually about negative interest rates.
Right.
We all talk about the lending side of negative interest rates, and to some extent investment, but we ignore completely the impact on savings. And the search for yields, capital outflows and things like that. Could you comment on that?
Sure.
And finally, from what you were describing, giving negative rates to banks to lend and so on, appears to be some success. But how different is it? Actually, it's not very much different from Friedman's helicopter bank.
Okay.
Yeah. Is it being seriously talked about in Europe?
But
As I said,
yeah.
your problem is lack of demand. Hell, float down, just throw down a lot of money from the helicopter, people catch it and then spend it. I know the Japanese are talking about it, but the government is very firm against it. But I think, can you comment on it and what's happening in Europe regarding?
Okay, let me. It's a long list of questions. Let me comment, relatively quickly. Yes, the growth is slow in Europe. I think if we really from the supply side of it, and that includes the structural reforms. We are the labor. I showed you a little bit of that, but that's just one rough calculation. But the potential growth is not going to be above 2% in Europe. It'll probably be a little less than. So this 1.5 is not a bad achievement for that.
What is full employment in Europe?
Well, the full employment,
5-6%?
it would be before the crisis it was sort of 6-7%, and we are now at 10.5 on average. So there's ways to go. So you could have faster growth for a period, but then you start to hit the sort of potential, and the potential for many European countries is not that good because of the one big thing is the aging population. We have first example instances of that is already in Europe. Finland being one of them. We've had declining working age population for 5 years. Not a big decline, but gradually going. Declining, and it'll continue another 10 years or so. And Germany is expected to have significant problems in that, and they are actually getting ready for that. That's why they are so tight on fiscal policies. They want to get the debt low so that they can then eventually spend a little bit more on pensions and also especially on the social care and medical care of the elderly people. So this is Europe doesn't have big potential. So if you want to increase growth potential, obviously structural reforms would help. Labor markets are still unionized, relatively tightly controlled, but more flexibility is being introduced. Germany is actually a very good example. They had a big set of reforms, and that's why they are doing so well now, which introduced a lot of flexibilities, so that the length of the working work can be negotiated by the company, and people work long hours when there's demand and you need to produce a lot, and then they take time off when there's less need for much large for the production, and these kinds of arrangements, something we call them something like our banks or labor banks. So in some sense, you keep track of that. There's an overall, but firm has discretion or together with labor, there's sort of sense saying that, okay, this is our peak season, let's work hard, let's produce a lot now because there's a lot of demand. And then the other season, we want less. And these kinds of arrangements are becoming more popular. But it is difficult. If you have very organized unions and so forth, negotiating this to become prevalent practices is difficult. But it's happening gradually, at least in some countries there. So that I think is important, but I think the potential is low unless you can somehow get new innovations there in the European economies. There's a fair amount of that, but it's difficult to say. I mean, there's a lot of obviously university. There are a lot of young people go through the universities and get training in IT and digitalization, but we don't know what the outcomes are going to be on this. And of course, the digitalization may bring bigger changes in the labor markets, which again require even more flexibility of the work practices. So these changes are coming, I think, and has to be acknowledged. The infrastructure spending is an interesting one because in quite many cases, I mean, I've talked to some government officials in just a few countries, but I know this, Finland obviously being one of them, is that in many instances the infrastructure is fairly complete, unless you start to get, the population is not increasing.
Eastern Europe is where you could.
Eastern Europe you could, but then the Germans don't necessarily want to invest in it, unless the Eastern European countries, you could have the foreign companies that build the new roads and so forth, but then they have to get somehow a return on this, and this has proven to be difficult to get an arrangement whereby you have toll roads and so forth, where your investors are provided a reasonable return, not too high but not too low.
Even aren't your rails getting old?
Some of them are getting a little old, but there are more and more of these fast trains going on in Europe, going around in Europe and so forth. So yeah, but there is a sort of reinvestment has been done, but whether you can introduce a new transport mechanisms and so forth is a bigger question. But I talked to Finnish ministries, and they're not coming up. It's kind of interesting. Usually, the Ministry of Finance has to sort of say that not too many new projects and so forth. Now the Ministry of Finance is encouraging, saying, why don't you introduce us a few more projects on roads and railroads and ship routes and so forth. so I think there is a sense in which that the infrastructure is fairly complete, and then you'd have to find some new innovative ideas about what can be done with the infrastructure. I think some of the Northern European countries certainly could have flexibility to introduce more, and so this is a debated area in this area. So let me, on the
On a word from France, I worry about
France. Yeah, I tend to worry also a lot, but then somehow they, and obviously the present government has been a relatively weak one, and the performance has been even weaker than some of the other. But then if you look at afterwards, especially the Sarkozy governments, and they were not that bad, even though the debate was horrific there as well. So France is the debate is very political, but then somehow the economy produces not top results, and they are not on par with Germany in this, but they manage to come along and they get some growth and so forth, and they're certainly far better than some of the southern European countries like Italy, for example, where the political situation seems to be much more disrupted. So let me come to the negative rates. Again, let me be brief here. This is a territory that the central banks are sort of testing, as I said, moving very gradually, trying to see what happens. And you're right that obviously in the longer term, if these prevail in the longer term for several years, we will start to see other effects. We will start to see the effects on saving and pension funds and so forth. And people are getting a very low return on their saving. Those who are close into retirement or retirement are worried about this situation. These effects grow bigger if these rates remain negative for longer periods. So this is an experimental time. I definitely agree. Personally, I'm not a great fan of these negative rates. I'd rather buy more assets to the central banks. There we know what we do. We take them to the balance sheet, keep them to maturity, and get eventually the money back, investment back, and sometimes make a profit because you actually buy at depressed prices.
helicopter money.
Helicopter money, yeah. It's not being seriously discussed, I think. You see, I think the difficulty, there are of course different versions, but it's really a combination of fiscal and monetary policy. Government handing out cash to the citizens and then financing it from the central bank. That, I think, maybe a one-off, yeah, but you see, the trouble is then the political balance between central bank and the government changes, and then we would go back to the older mode where the central bank is no longer independent. So the central bankers, I think, heavily resist on this idea. But if things really go back, and something like that might have to be eventually done, but don't quote me.
We have not done very well with independent central banks either.
Right.
The global financial crisis. Yes, sir. Introduce yourself and ask a question.
So my name is Albert Hammond. I'm from the UK, and I'm here on a short-term project here in Malaysia. So thank you for this opportunity. So my question is this: you as you mentioned, many economies in Europe are net importers of oil.
Yeah.
So it suggests to me that if oil prices over the past couple of years has been increasingly trending downwards, then that suggests that this low oil price should drive higher economic growth. So my question to you is, why is this impact of low oil prices not driving faster growth GDP growth generally in this, say the G20 countries. And I guess the second question is, yesterday President Obama was in the UK talking about how in his opinion, it would be better for the UK to continue to stay in Europe. So from a US-UK relation perspective, do you think that Britain's exit out of Europe will drive stronger ties within and almost economic growth within the UK because of the special relationship that the UK and the US seem to have?
Okay, let me answer you. First of all, the oil prices. This is what you said about low oil prices and faster growth. This is what you would expect, but somehow we are not. Maybe it takes time, but we're not seeing it. And I think there are a couple of reasons. One is that the decline has been so big and so rapid that now what has happened is that these risks of deflation overall in the economy have surfaced, at least for some economies. And then you couple that with the fact that those countries which are oil producers will obviously the price decline is a major creates major negative effects on revenues and so forth are also one part to play. So those who importers, there is the question that the inflation rates have gotten very low because good part because of the oil prices. And then some of the trading partners, the rest of the world, the oil exporters are going to be in difficulties because of the low prices. So I think that's where maybe the standard effects are weak, or we're not seeing them so far in this. So I think the situation is different. If we had a more moderate decline in oil prices and a sustained moderate decline, this issue of deflation and so forth, and also the oil producers, a moderate decline in oil prices is usually a big deal for them. I mean, they are often very rich countries, Arab world, Norway, so forth, and there some decline is not a big deal. Obviously, there are producers which are emerging countries where even smaller declines have an impact there. But I think it's the fact that it's so big, and it happened relatively suddenly, and that's why we are not seeing these growth effects of oil prices, except the negative ones in the producing countries.
And he thinks Brexit is
the UK. I mean, this is U.S. politics, and let me not comment. But I also read this morning the summary of what Obama had said, and it was a pretty strong statement, I thought. And more generally, I think the one thing which certainly was there is that it was suggesting that these new negotiating the new trade agreements is going to be difficult. So I think it would be naive for the UK to expect that this is a straightforward matter to do. It would take a lot of time and negotiating, and they would have to do it probably in different directions, in different ways, and so that would create a lot of uncertainty for possibly several years. So that's one issue that is important. The second issue is that obviously is yes, more political, but one in some sense UK is isolating it from rest of the closest contact is Europe, and as we saw from in terms of the trade numbers, that's the closest contact. And this idea of let's decide to isolate ourselves from that, at least to a degree, it doesn't sound very So I'm surprised by that idea. I continue to be surprised by that idea. And I think Obama was saying also this idea that this idea of let's somehow going into isolation. Usually is not a good idea. In economics also, I think certainly individual countries, including the Nordic countries, very much know that they prosper because if they have good trade, extensive foreign trade, and it goes well, that's when you prosper, not in isolation. Even though sometimes you hear in these small countries as well this idea, oh, we better do it ourselves. But these isolation countries which operate in isolation usually do badly.
Well, perhaps you should know that the United Kingdom is the U.S. most reliable ally against Putin.
Yeah.
And with UK out of EU, NATO might not be similarly inclined against Putin the same way as it is now. So, please. Oh, wait. Gentlemen.
Yeah.
You'll be first.
My name is Yung Yan Pin. retired from the banking industry. Professor, thank you very much for your very extensive and very comprehensive presentation, particularly concerning the various aspects of the economic problems in Europe, characterized by high national debt, high unemployment, and perhaps very high household debts as well. My question here is, to what extent these problems have been due to the impact of very populist type of policies on social welfare, providing very extensive coverage for unemployment, pension, better health care and so on. Is it mainly due to the populist policies of most of these European countries over a period of time? Thank you.
Yeah, okay. So let me try to answer that. This is a difficult question, but if you look at this, this especially this sovereign debt crisis in Europe and these what I call crisis countries in my graphs. I didn't have the graph with me, but I have a very telling graph, which is that if you look at their current accounts, not from the crisis years, but from the older times, and also public debts or government deficits from the older times, what you see is that the current account deficits became very big in the early years of 2000, well before the financial crisis. So that's telling us the overall economy, in particular the private sector, was borrowing a lot. And this, whereas the public balances, there was some deficit, but they were not big. And the public balances started to get really big when the financial crisis came. And so first private borrowing, and then it moved to the public borrowing. For example, Greek current account deficits in sort of year 2004-5 were in the sort of 15% range of GDP. 1.5. That's a huge current account deficit. And they were just borrowing, and also in this period, if you look at the euro area, country-wise, the euro area countries, how fast they grow. The Greek was the fastest growing country from about 2000 to 2007. They were borrowing like crazy, and it was most of it went to private consumption, in fact. Private consumption as part of the GDP, that ratio got extraordinarily high. So these countries, there were obviously, I think it was more of private borrowing first, and not so much on the public borrowing. Obviously, there are country differences. I'm sure there are cases where also building up excessive social services and so forth might be a problem, but that's you don't track that so easily. But by this idea of looking at the current accounts and looking at the whole euro area period shows you very clearly what happened was the euro basically, when it was introduced, brought the interest rates on debt in these countries, some of these countries, down a lot from late 90s onwards, more or less to the German levels. The markets evaluate the Greek public debt just a little bit above the German public debt, which is crazy. I think that was a market mistake also, in fact. But nevertheless, the households and companies, and in particular households, took advantage of that. They saw that they can borrow very freely, and they did. And that's what happened. That's really the first part of it. And some of it spilled into real estate. In some countries, the real estate prices rose a lot because of this new borrowing, and that's the story of Ireland and Spain in particular, but to some extent in the other countries too.
Okay, we will take the last two questions. Oh, okay. So we have last two questions, answer, and then the last two questions over there. Yes, you and you, sir. You, please. You first.
Professor, my name is Lo.
My question is related to the word exit, but it's related to a bank, HSBC. Why was that HSBC was pondering to move its HQ to Hong Kong quite some time ago? I mean, quite recently, and then decided to stay back in London. Could you explain, from the perspectives of Hong Kong and London?
I don't think I can answer that properly.
Could we ask that question?
Sure.
Hello, my name is Thye, a PhD student at Monash University. So the ECB has launched QE for a while, and so far the government in some European countries has done nothing real. So my question is the ECB actually helping the government to cover the weakened economy of some European countries? Is this true? Is ECB really independent?
Well, first of all, by the legal rules, we are very independent. You can't fire me. The government cannot fire me or our governor. Or nobody can fire unless there's a sort of civil criminal offense, for example. Then you can fire the person. Suppose I became an alcoholic and started drinking and didn't go to work. Then obviously after a couple of weeks they would kick me out. That can be done, but otherwise for policy purposes or political reasons, you cannot. So there is a heavy degree of independence there, and obviously these debates come. Like last week we've seen some debates in Germany, but if you I think once you read about this, I think you better look at this. What's the motivation? What are they talking about? Obviously there is a good cause, like saying that okay, the German pensioners are being hit. They're facing zero returns. Yes, they are. But that's not the reason why ECB should not do QE. Or ECB is looking at the Euro area economy as a whole and its problems and try to improve that. So you don't just focus monetary policy and central bank's actions on particular things like pensioners in Germany or other countries. So I think one has to realize that monetary policy is for the overall economy and not for particular countries or particular groups. You can't do much monetary policy in the Euro area individual countries. It has to be based on the average, and there's not much you can do about the individual countries. You can do. There are, of course, what's called the macroprudential policies in this place, which are towards better financial stability, and many of the instruments are national. So in the EU, in the Euro area, member countries have their own sets of macroprudential policies, and they can be used. There is also some coordination at the overall level, but many of these measures are national. And so, but the objective is financial stability. It's not monetary policy, which is day-to-day management of the overall development in the financial system and the macroeconomy growth and so forth.
Now we have two questions from the center. The gentleman at the back first. The answer to question one is there's no good answer.
Okay. Yeah.
I'm Hugh Gill, I'm head of psychology at Sunway. 2 or 3 quick observations and then perhaps a counterfactual. I was actually a politician until 2008. I retired from public life and I represented Bingley. You may remember that Bradfield Bingley was the second bank to collapse.
Right.
So I stood down from public office just before that collapsed. I remember driving down the main street the night it happened. There were over 300 television crews from around the world standing there to film in front of the head office that the second British bank had collapsed. Then I became a banker. Which is quite funny, and looked at how things are going to go wrong in China. And I come from the place that basically invented the modern world. We were the first people to do free education. We did state welfare. We introduced, actually, the modern union idea of inflation, an end to negotiating and cutting wages. So we introduced all these things.
What's your question, sir?
My question is all this actually about the decline in population? The collapse in Europe and America happened just as the baby boomers started to retire and made all their retirement savings available. There are simply not enough young people, and your figures, in fact, for somewhere like Spain, unemployment 15%, but actually amongst young people, 25 to 30%. What this is about is the new normal, that there aren't enough young people, economies aren't going to grow anymore because all that was based upon increasing populations.
Well, okay.
Ask a question after.
Understanding and reading about the economics and then hearing from you, the amount of uncertainties has actually come to a place where I could see an imminent Great Depression because of what we call age of stagnation. Yes, it's about similar to the gentleman behind me actually wanted to ask the question. So, yeah.
Okay, I'll try to answer this quickly. Certainly decreasing population in many European countries, and as I said, it started in some of them. Japan, of course, has had it for about 10 years. Finland for 5 years, the first one in Europe, and more countries coming, including Germany. China, with the one-child policy, is going to face this problem soon. And this, we know. I mean, if we a little bit of economics, one thing is going to be missing from the future, which is that there is no growing labor input, and therefore one contributor to economic growth is going to be negative rather than positive. Which obviously, unless you do somehow mysteriously do better on other fronts, it means that the growth is going to be lower, and we recognize this in Europe. Sorry?
The refugees are coming.
And the refugees are coming in. No, not yet. We don't know yet. I mean, we have. I didn't take it with me, but we have some numbers. We've looked at this problem for Finland. I'm afraid it's not going to. It makes it a little smaller, this decline. But on current estimates of how many refugees are coming, it's not going to resolve the problem. And anyway, there's the adjustment to getting them to the labor force. So it's a big factor, and it has to be taken into account. There are other things which are important, which are somewhat related. For example, after World War II, depending on the country again, and I'm not speaking, but what happened was that the labor force was getting better and better educated, in the sense that the younger cohorts were better educated than the older cohorts in the labor force. That effect in the Western economies is gone. The youngsters are no longer better educated than the other older cohorts in the labor force, by and large, and that is another impact which doesn't come out but it clearly has an effect on these things. So I think the growth potential from that point of view is going to be less in the future. I think I'm still thinking it's going to be positive, but it's mostly relying on this total factor productivity or innovations, technological improvements, and so forth. That has not, there are some economists I know, like especially Bob Gordon, who claims that this is the source of stagnation. I actually don't think that's going to be the case. Hard to say what happens on that. And first of all, many of the countries are not at their capacity yet, which means that this is a supply side thing. It's not affecting the situation that much. That's my feeling about this. So I think it's a bit more complicated. I think if you really want to know my view on the financial crisis is, I've been an economics professor before joining the General Bank, and this is a big debate, an ongoing and unresolved debate in economics. But this is in most serious academic research, is the financial system inherently stable or unstable? Does it get into difficulties at times, which is the unstable view? And I actually tend to believe that way. And you see what happened. You have to remember one big trend. What happened was in the 1980s, where Reagan and Thatcher was, let's deregulate markets. And of course, in many cases, the deregulation brought big benefits. But this idea, let's deregulate the financial system a lot, may have been a bad idea. And we are facing the consequences of that thinking. That's my sense. This is a very personal view, but that's my view on this thing. So I tend to believe that you cannot leave the financial system unregulated, even though it's difficult, because they are also very good innovators, as we've seen, and that innovation continues. The next ones looks like they're going to be in the payment systems and so forth. There's going to be a lot more IT coming in, and one just has to worry about the stability of the system all the time. That's my personal view on this, on the financial crisis.
Seppo, thank you very much. You've given us 2 good lines.
Thank you.
You end 2 good lines. The first, in relation to the young people, the answer was, a country doesn't have to be reproductive in order to be productive. The second one, in answer to the question of the role of the banks versus the irresponsible public finance spending too much, is that what has happened is Wall Street has kicked over the rice bowl of Main Street. And the large public debts that you see was because of the government bailing out the private banks and hence assuming the huge debt that we have seen.
Yeah,
And
that's
thank you very much for coming.
Okay.
We would like to give you a momentum
okay.
of your
Thank
visit.
you.
Thank you.
Thank you very much. Okay, thank you.
Thank you very much, and thank you all for coming. And I'm sorry we didn't have enough time to go on. Thank you again. See you at the next event, and have a good weekend.